The class returns from the break. Welcome back. Let's talk about term insurance, which covers the insured for a specific period of time. Term policies can be for 1 year, 5 years, 10 years, or even up to 30 years. Most insurers offer term policies to people up to age 75 or 80. Instructor explains level premiums. When you buy a term policy, the premiums are usually level for the duration of the term. So, if you buy a 5-year term policy and pay monthly, your premium will be the same each month for all 5 years. Instructor introduces types of term insurance. There are 3 main types of term insurance: increasing term, level term, and decreasing term. With increasing term, the face amount of the policy increases as the insured gets older. Dawn, can you think of a reason someone might buy increasing term insurance?
If they're expecting to have more children in the future.
Exactly. As a family grows, their insurance needs may increase. Pearl, are you and Dawn planning on having more children?
No, I think 2 is plenty for us.
Never say never, honey.
If you change your mind about more children, increasing term could be a good option. Let's take a look at a graphical representation of increasing term insurance. Instructor draws a graph with age on the x-axis and face amount on the y-axis, showing an increasing line. As you can see, the face amount increases over time. In this example, we have a 20-year term policy for Pearl, starting at age 30 and ending at age 50. Instructor moves on to level term. Next, we have level term. With this type of policy, the face amount stays the same throughout the term. Instructor draws a graph with age on the x-axis and face amount on the y-axis, showing a straight horizontal line. The face amount is level from age 30 to age 50 for Pearl's 20-year term policy. Instructor explains decreasing term. Finally, we have decreasing term. In this case, the face amount decreases over time. Why might someone choose a decreasing term policy?
Maybe if they have a mortgage that they're paying off over time?
As the mortgage balance decreases, so does their insurance need. That's a great example, Pearl. Another reason could be that as children grow up and become self-sufficient, the need for insurance to cover their education expenses decreases. Instructor draws a graph with age on the x-axis and face amount on the y-axis, showing a decreasing line. With decreasing term, the face amount starts high and gradually decreases over the term of the policy. Instructor discusses premiums for each type of term insurance. Now let's talk about the premiums for these different types of term insurance. Term premiums tend to be much lower than premiums for permanent forms of insurance. The reason is there exists a high probability the insured will outlive the term, and thus the insurer will not pay out the death benefit. Instructor draws graphs with age on the x-axis and premiums on the y-axis for each type of term insurance. For increasing term, the premiums usually increase as you get older, since you're getting older and receiving more coverage. With level term, the premiums remain the same throughout the term. Decreasing term is a bit counterintuitive. Even though the face amount is decreasing, the premiums remain level. This is because as you get older, you represent a higher risk to the insurer, even though you're receiving a smaller payout. The increased risk due to age and the decreased risk due to the smaller face amount offset each other, resulting in level premiums. Instructor provides examples of premium costs. Let's say Pearl wants $450,000 of coverage. For a 20-year level term policy, she might pay $50 per month or $600 per year. If she chose decreasing term instead, her monthly premium could be around $30 or $360 per year, since the insurer's risk is decreasing over time. That's a savings of $240 per year compared to the level term policy. Instructor checks for understanding. Does anyone have questions about the different types of term insurance or how the premiums work? The class is silent, indicating understanding. Great! Let's move on to two important features often found in term insurance policies: renewability and convertibility. Instructor explains renewability. Renewability gives the policy owner the right to renew the policy at the end of the term without the insured having to prove insurability. So if Pearl has a 5-year term policy, she can renew it for another 5 years, even if her health has declined. The insurer can't deny her coverage or require a medical exam. However, the premiums will increase at each renewal to account for Pearl's increased age and risk. Some policies include this feature automatically, while others offer it as an optional rider for an additional cost. Instructor draws a graph to illustrate renewable term premiums. Let's look at how the premiums might change for a renewable 5-year term policy. Instructor draws a graph with age on the x-axis, premiums on the y-axis, and a stair-step pattern to show premium increases every 5 years. At age 30, Pearl buys the policy. When she renews at age 35, her premium goes up and stays level until age 40. Then it increases again and remains level until age 45, and so on. It's important to note that the insurer can only increase premiums by class, not on an individual basis. So Pearl will always pay the same rates as other females in her original underwriting class of preferred even if her health has deteriorated. Instructor explains convertibility. The other common feature is convertibility, which allows the policy owner to convert their term policy to a permanent policy, like whole life, without proving insurability. Let's say Pearl bought her term policy at age 30 and decides to convert it to a whole life policy at age 45. Maybe her expenses have gone down and she has more discretionary income to put towards insurance. When she converts the policy, the premiums for the new whole life policy will be based on her attained age of 45, not her original issue age of 30. Whole life premiums are more expensive than term premiums, but the policy will provide coverage for Pearl's entire life, as long as premiums are paid. The sooner the term policy is converted, the lower the whole life premium will be, because the attained age will be younger. Instructor discusses the relationship between term length and premiums. One thing to keep in mind is that the longer the term of the policy, the higher the premiums will be. A 10-year term policy will have higher premiums than a 5-year term policy because the insurer is locking in their risk for a longer period. However, if you compare the premiums for the second 5 years of the 10-year policy to the premiums for a new 5-year policy at the end of the first term, the 10-year policy premiums will be lower. Great job on completing this video. Now it's time to test your comprehension of the concepts we just discussed. This video corresponds to ICAP quiz course number 14. Remember that number. Click the link in the comments section to access the Insurance Class Assistance Program, also known as ICAP. Once you're there, look for quiz course number 14. This quiz will help us see if you truly understand the material and are prepared to move on to the next video. Don't forget, ICAP quiz course number 14. Good luck and keep up the great work.